Welcome to our Wharton webinar series. My name is Robin Turner, and I'm the Associate Director of Lifelong Learning and Alumni Relations. Today, we welcome Professors Arthur Van Bentham, Ben Keyes, and Christina Zhu, who will be discussing new research in ESG. We hope you'll stay to the end to learn more about Wharton's ESG initiative. You're welcome to submit questions at any time. The Q&A button can be found on the top right side of the screen. If you do not see the Q&A button, please exit full screen mode. After the brief presentations from Ben and Christina and discussion moderated by Arthur, they will be taking questions from the audience. For specific questions, please indicate to whom your question is directed. Finally, for closed captioning, simply click the CC button on the bottom right corner of the video player. Now, please join me in welcoming Professor Arthur Van Bentham.
Thank you, Robin, and welcome everyone to the Wharton ESG full webinar. So over the past few years, we've seen enormous growth in ESG-related research and teaching across all Wharton departments. And here at Wharton, we strive to conduct academically rigorous, but also practically relevant research to investigate when, where, and how ESG factors impact business value and financial markets, and also to help identify solutions that contribute to tackling pressing issues such as environmental degradation and climate change. And today we will showcase some of this research, and I am very excited to introduce my two Wharton faculty colleagues who will tell us about their latest projects, Ben Keyes and Christina Zhu. So let me first introduce Ben. Ben Keyes is the Rowan Family Foundation Professor of Real Estate and Finance. His recent research has focused on climate risk, housing, and mortgage markets. And his research has been published in top academic journals in economics and finance, but also has been extensively covered by The Economist, The Wall Street Journal, and The New York Times. Christina Zhu is a Harold C. Stott Assistant Professor of Accounting at the Wharton School. Her primary research interest is empirical financial accounting. She's published her research in top-tier accounting and finance journals and also serves as the associate editor at the Journal of Accounting and Economics, and she's on the editorial board of various other academic journals. So without further ado, I will pass it over to Ben.
Great. Well, thanks so much. It's really a treat to be here and to share with all of you a bit of the work that I've been doing, trying to understand what's going on in housing and mortgage markets as it relates to climate change, with a focus on homeowners insurance markets. And so I wanted to tell you just briefly about a research project I've been working on with my former PhD student, now professor at the University of Wisconsin, Phil Mulder, on property insurance and disaster risk, and just give you a quick overview of this project. The challenge that we were running into in understanding the turmoil in homeowners insurance markets, there have been so many headlines over the last couple of years, very high profile exits of some big insurers from risky markets, lots of stories about the price of insurance going up. Is we, as researchers and as policymakers, face a big challenge when it comes to data. There's simply not a national database of how much homeowners pay in their insurance premiums, what types of contracts they have, and so on. And that puts policymakers at a real disadvantage, and it puts researchers at a real disadvantage. There's kind of a dearth of research on this topic because data has been so limited. So Phil and I set out about 3 years ago to address this problem. And what we've done is we've built a data set of homeowners insurance premiums out of mortgage escrow payments. So when you make a mortgage payment, you're covering not just the principal and the interest, you're also covering the taxes and the insurance. And we can back out what portion of the payment is going towards insurance if you know the characteristics of the mortgage and the property tax regime where you live. And this kind of builds on an earlier method that I developed in another paper. We realized we could transport that to this setting to really kind of build an unprecedented data set of homeowners insurance premiums. At the end of the day, we have about 47 million observations of how much homeowners are paying in their insurance premiums. And we can see many repeat changes for the same property. So we know that we're not just changing the composition of the samples. So what can we do with this really cool data set? Well, we can make some maps, which look something like this. You might have seen a map like this in the New York Times over the summer. We worked with the Times to build an interactive map where you can click on your county and find out more about disaster risk and also about premiums there. So you can go find that article on the Times website. If you just search for mortgage insurance, or sorry, homeowners insurance, and throw my name in there. What jumps out from this map? Certainly, Florida and the Gulf Coast are very expensive areas of the country when it comes to homeowners insurance, but also areas like North Texas, Oklahoma, and Colorado, which jumped out at us. The Colorado Insurance Commissioner's Office reached out immediately after we published these maps to say, your data seems to have more nuances than even what our office has in many cases. So this is kind of leading into a lot of interesting conversations with policymakers and other researchers to try to understand what's going on. We can zoom in with our data at the zip code level, and we can make maps of places like Miami-Dade. Here you can see that along the water and South Beach, that premiums are now over $8,000 a year on average for the average homeowner. You should think of this as single-family homes. And then you see the gradient as you move away from the coast. Still extremely expensive further from the water. But this is, again, the kind of unprecedented granularity to the data that we've built because we built it off of mortgage data. So here is the other big takeaway. The big picture is how much premiums have increased since 2014. So we estimate that premiums have increased about 34% from 2020 to 2023. There are quite a few different explanations for why this might be the case. One is uncertainty around climate change and the frequency and severity of disasters, whether that's wildfires, hurricanes, or other river-related floods. It may also reflect issues around regulatory frictions and challenges that some insurers face in operating in certain markets that's led them to pull out and led to a reduction in competition. There's also inflation. So we've seen an inflation in the cost of materials. We've seen inflation in the cost of labor to repair homes after they've been damaged. But the inflation has another side as well, which is related to capital markets and thinking about going from a world of basically zero interest rates to a world of non-zero interest rates and what that's done to insurers and reinsurers' cost of capital. So I'm going to wrap up there to try to stay on time and hand it over to Christina, but I'm excited to discuss more about this work, some of the broader implications, and any follow-up questions that you might have. Christina, take it away.
Awesome. Thanks so much, Ben. It's really a pleasure to be here to talk about some new research that my co-authors and I, Chen Lee at Stanford and Eddie Watts at Yale, have been working on. We're really focused here on retail investors and ESG news. So in this paper, we're looking at whether retail investors value information about the environmental, social, and governance-related activities of firms, so ESG-related activities of firms. And not only are we interested in that, we're interested in if they do value this information, why do they value this information? Is it for pecuniary reasons, meaning the risk and returns of their portfolios, or is it for some non-pecuniary reasons? And we really want to address these questions because it's unclear if the average retail investor, the focus of our study, values information like this, why they value this information, and if they can actually profit from trading on ESG related information. So part of our motivation is this huge growth in ESG investing globally, right? ESG orientated assets under management is set to grow much faster than the asset and wealth management market as a whole. We're also motivated by some related literature. And this is a huge focus of study in the existing literature, but there has been some disagreement about the extent to which retail investors value ESG related activities and why they might value such activities. A lot of the disagreement and the mixed results have to do with differences in research method, right? Some people are doing experiments or running surveys. Some people are using empirical methods, right? Some studies are focused on very specific settings, right? Securities with a specific ESG mandate. And some studies find differing results because they look at firms' own disclosures versus some third-party information, which might be more verifiable. Now, we're also interested in looking at why investors are trading on this information. Are they willing to trade off financial gains for ESG performance? And this is important because if we are to find that some investors are willing to trade off financial gains for ESG performance, this is where we could potentially find it because retail investors, unlike most US institutional investors, have no fiduciary obligations. They're not required to maximize their portfolio performance. So there's also some real world implications. I think we all know that ESG is a hot topic. There's a lot of disagreement across states, right, and what states have decided they can or cannot do with respect to ESG investments, ESG considering ESG factors. There was a Department of Labor rule on banning or trying to ban the use of ESG factors in retail investors' retirement accounts, and then former President Biden used his first veto to defend the rule on ESG investing. It's also relevant because the SEC had been proposing rules on climate related disclosures. And then recently, in March of this year, they actually adopted the rules to enhance and standardize climate related disclosures for investors. So our study comes in by showing whether or not this type of information could actually be useful for retail investors that the SEC is trying to protect, right? So we want to study this question, but it's difficult to do so because there are many different issues. Issue number one is their information processing constraints. We can't really just ask retail investors if they care about ESG information because most retail investors don't know what ESG is. I found this really interesting in this FINRA survey. 21% know what ESG stands for, and a quarter of retail investors in this survey thought that ESG stood for earnings, stock, and growth. And that's incorrect, right? So to address this issue, we're going to look at news events. They're much more salient. It's clearer, right? People have heard of this Boeing 737 MAX scandal, right? Issue number two, there are measurement issues, right? Many different ESG rating providers are giving different types of ESG ratings. These ESG ratings capture different things, right? So is it the impact of a corporation on the world or how the world climate might impact the corporation, right? This is very confusing to investors because ESG proxies are not measuring the same thing. And we're going to get at this very simply, right? We have different events that might have positive implications for the ESG performance of a firm. For example, this Occidental Petroleum signing clean energy contracts, that's positive environmental practices, but it might have some negative implications for the firm's stock price. So in this case, the market did not like this event. There was a negative stock price reaction, negative 3.6%, when this news was released. So we're going to look at a sample using FactSet True Value Labs Spotlight Data Solution. So this is the most important positive and negative ESG events. They use artificial intelligence on unstructured data. And importantly, the data include the date the news first becomes public, coverage from independent media outlets, and it covers a pretty long sample period, December 2015 to August 2022. And so in the end, we have about 54,000 distinct ESG related news events for over 3,000 unique US publicly traded firms. So I just want to give a few more examples of the types of events that are in our sample. So here we have in 2021, Home Depot. They were punishing a worker for wearing a Black Lives Matter logo. And this was negative labor practices. This will be categorized as a human capital event. And it was also accompanied by a negative stock price reaction. But we also have some more positive news, right? So this is Hasbro dropping the Mr. from Mr. Potato Head. This was considered inclusive, and it's positive customer welfare that's tagged into a social capital category. And it was also accompanied by a positive stock price reaction of 4.4%. Now we have a diverse array of categories in our sample, right? Environment, social capital, human capital, business model and innovation, and leadership and governance. Our first main result is that retail investors definitely care about this type of news. Retail trading volume increases by 5.7% in the 3-day period around the release of ESG news. So our inference is that they trade on this type of news. This news is important to their portfolio allocation decisions. Now we want to decompose this some more, right? How does this compare to the traditional financial news that they might see in the media? Because again, retail investors, they don't know about how to how to process many different, more complex types of information. They're looking at the media when they want to figure out what's going on with a firm. So ESG news events are somewhat in the middle in terms of how much retail investors care about them. They're more important than dividend announcements and analyst forecast revisions, but they're not quite as important to their trading decisions as earnings announcements, guidance, or mergers and acquisitions. There's also a lot of variation across ESG categories, right? Environment and human capital seem to be the least important, social capital in the middle, and then leadership and governance are at the top in terms of our empirical results. And this is very much in line with what previous research has found when they ask investors in surveys, what do they care most about? They seem to care most about governance. We also find a lot of time series variation, right? In our long sample period, the greatest reactions are in the recent years. And then finally, we get to our second research question, which is the why, right? Why is it that they're trading on this information? Why do they value this information? Now, it could be two different reasons, right? Pecuniary, in the sense that this type of information tells us something about an issuer's firm value, risk, and returns, right? For example, an investor could realize that certain areas of PG&E services cover large areas that could be potentially affected by climate risk, right? And they want to price that risk. Potentially, travelers could no longer visit SeaWorld because of its negative impact on animals. That affects cash flows, and investors would care about that. The second reason is non-pecuniary. Maybe investors prefer to own high ESG or CSR assets. There could be non-pecuniary reasons. This could be an individual avoiding so-called sin stocks, right? So our evidence indicates that retail investors tend to trade around ESG news events for pecuniary reasons. And here I've plotted out, the 4 different quadrants, low ESG, high returns, low returns. And I want to focus on what I've highlighted in blue here, which are the off diagonals. When ESG performance and return performance disagree, how do retail investors trade? They seem to trade in the direction of the returns, right? So it doesn't matter if the event reveals some negative ESG performance. If there are high returns, then the retail investor is going to buy. And conversely, when the event has low returns, even if it's a positive ESG event, the retail investor is selling. So in this sense, we find that there's no evidence of trading for non-pecuniary reasons, and some evidence that the pecuniary motivations are actually stronger in states with higher ESG scores, blue states, as opposed to red states. Now, I want to quickly conclude. What we find is that retail investors do value ESG-related information. They trade for pecuniary reasons, right? So a big takeaway is that ESG news is financial news. They're going to trade on this information just like they trade in response to traditional financial news, okay? So I do want to quickly conclude because I want to get to the Q&A. So thank you everyone for your attention, and I'm going to turn it back to Arthur now.
Great, Ben and Christina, thank you for your presentations. I also want to let everyone in the audience know that you should absolutely feel free to enter questions at any time. I have a number of questions that I would like to discuss with Ben and Christina first, but then we will get to your questions towards the end of this webinar. So Ben, if I can start with you, I was wondering if you could speak a little bit more about the possible impact of these higher insurance premiums on house prices. Like, do we see house prices change in response to these skyrocketing home insurance premiums?
Yeah, thanks. I mean, I think, the implications of this increase in homeowners insurance is only beginning to be traced out. And you can think about the different ways in which rising insurance premiums might affect households, right? So I've argued that this is like the first place where climate change is hitting people's pocketbooks in a very direct way. It's bringing the reality of climate change home. And, to the extent that insurance is reflecting uncertainty around climate risks and other disaster risks. With that increase in homeowners' costs of using a house, we would expect that would be eventually capitalized into house prices. That the value of a house should reflect sort of the forward-looking usefulness of that house, and if there's a higher cost associated with using that house, you can almost think of it like a tax, right? That there's just going to be a higher user cost on that property. I wrote an op-ed that was actually timely enough. It came out in the New York Times yesterday. That was about these costs and the ways in which they might shift sort of the perception of home ownership as a good investment, right? When you have rising and uncertain insurance, you have rising and uncertain property taxes to cover infrastructure. And then you have uncertainty around the asset value. How much is the house actually worth? And so I think at this point, I mean, at this point, we haven't seen a lot of evidence that this is taking a big bite out of home values. I think there's a couple of reasons for that. One is that in the housing market, we usually see responses first on the quantity side. We see a disconnect between how much buyers are willing to pay and sellers want for the asset, and we are starting to see a rising inventory of unsold homes in some of the most exposed areas. So I'm thinking like coastal Louisiana, parts of Florida. We are starting to see that accumulated inventory. I think the other kind of thing that's slowing down the process is the powerful demographics that are cutting against any sort of disamenity cost from rising insurance. So in the U.S., we have about 10,000 people who are hitting retirement age every day. So 10,000 people turn 65 in the U.S. every day, and that's going to continue for the next 5 years. And so there's a huge number of people who want to move to warmer climates, and that demographic pressure, combined with a housing shortage, has put upward pressure on prices. And so I think it's a question of like how this is going to play out in the long run and where we are going to see prices ultimately reflect these types of climate risks. But at the moment, I don't think we're there yet.
Great. The other thing that comes to mind is, I mean, the results you showed in terms of increasing premiums is pretty stark. And I mean, I hear a lot of people talk about it. People sort of have noticed that it's getting expensive. That said, I mean, insurance markets are also kind of famous for moving in cycles, right? So are we just looking at kind of a usual cycle that is peaking and it may ebb at some point again?
It's a great question. And I think, if you listen to the industry, they are saying this time is different. It's hard to know if that's the case or not. I sort of alluded to this very briefly earlier when talking about inflation, right? And how much of what's going on in these markets is a reaction to pandemic-related inflation that drove up the cost of materials, and how much of that is going to phase out when we see inflation come back to more normal levels, which is where it is right now. Although still elevated in the construction sector, there's still elevated construction costs and labor costs, materials. So some of those things may come back down. Big disruption when you go from a zero interest rate world to a non-zero interest rate world. The cost of capital shot up for these firms very rapidly, and when you read about the reinsurance industry in particular, these are the firms that insure the insurance companies. Their weighted average cost of capital went up by over 300 basis points in a very short period of time, challenging for them to raise funds, and they need to raise prices basically to offset the costs of capital. So if those kind of things moderate, then you might see them come down. But when you listen to the industry, they say no. They say those factors are there, but we are also fundamentally reassessing climate risk in a way that is stressing our models to the limit. And our data and our models are suggesting that we are going to have to continue to charge higher premiums, and that's especially true in areas of concentrated catastrophic risk. That more and more people are moving into harm's way, and those are exactly the kinds of situations where it's difficult to diversify. And so that's where we're going to continue to charge higher prices. There were 2 interviews with the CEOs of 2 of the largest reinsurers over the summer, where they said, expect more of the same. This isn't just a traditional cycle. And so I think that's the challenge right now is how far we're going to see these costs rise, and then how much that's going to stress households and stress these insurance markets.
Thanks. Christina, question for you. There's been a lot of research recently in climate finance, essentially showing how climate risk is priced into all kinds of markets. So we talked a bit about housing markets with Ben, but also muni bond markets, equity markets. I was kind of wondering, like, how do your results compare to the existing literature so far?
Yeah, so you're completely right. There has been a lot of research in climate finance and especially climate risk, right? Is this risk priced in various different markets? Now, our focus in this paper is on retail investors, which is a little bit different from looking at pricing implications, because a lot of the climate finance literature, especially let's think about equity prices, they're looking at institutional investors, right? Most institutional investors are going to be the price setters in these markets. They're constrained by fiduciary duty. It makes sense. They're more sophisticated. They would price this climate risk perhaps correctly, perhaps incorrectly, depending on the type of research that you're looking at and the setting that you're looking at. That's very consistent with climate risk being an important source of risk to a firm's cash flows, firm's discount rate, right? And same with the muni bond literature, right? So then the question is, where we come in, are retail investors able to price this climate risk, and do they view this the same way? So instead of looking at stock prices, for example, we are looking at trading volume where we know these are retail investors trading. Okay, so our results would say yes, very much consistent with the literature on climate-related risk being priced in these markets. You also mentioned housing markets, very much related to Ben's work, right? There's also a very interesting paper that's looking at housing markets and in areas in which people believe in climate change versus areas in which they don't believe in climate change. And in the believer areas, those that are the areas that are projected to be underwater, that's priced, right? So those housing prices are lower. But then if you look at areas in which people don't believe in climate change, it doesn't matter if the house is projected to be underwater. That doesn't seem to affect the housing price. So I will note here that home buyers probably are a similar sample of people as retail investors that we're looking at. They're not professional investors. They're people like you and me. So I would say our results, once again, are consistent with that paper because it matters what you believe in, right? How you perceive a firm's ESG performance, how you perceive some activity that a firm is doing that may or may not affect the cash flows that you can realize in your portfolio. Just like a home buyer looking who does or doesn't believe in climate change would look at the projected future price of their home and then price that in.
Christina, I got a quick clarification question. You mentioned the term ESG trading. If you could briefly define what you mean by ESG trading.
Yes, so this is an important distinction because in our paper, we are talking about trading on ESG related information, which is like using this type of information in a retail investor's trades, as opposed to another type of definition could be, these non-pecuniary preferences, right? Wanting to not hold sin stocks or not wanting to hold oil and gas firms, right? So when I talk about ESG trading or trading on ESG information, I'm talking about using this information to make better investment decisions, caring about the implications on a firm's cash flow, a firm's risk, right? Which climate risk is just another type of risk, right? So that's what I would like to clarify. Thanks. Thanks for that question.
And so how do you view your results in light of the sort of generally growing demand for sustainability reporting and sort of reporting information about companies' climate risk?
Yeah, there's certainly a lot of demand for this type of information. And one particular paper I'd like to mention is there was a working paper that showed that retail investors don't seem to care about firms' own voluntary disclosures about sustainability. So that's where regulation could come in. And we did see that the SEC recently adopted their new climate disclosure rules. They've been talking about it for years. So one of the SEC's mandates is to level the playing field between retail investors and institutional investors, make things easier for retail investors to understand. So where our study comes in is, before the rule was passed, seeing whether retail investors actually use this type of information could inform policymakers on whether this type of information should be mandated or not. And once again, it's ESG related information that would affect the cash flows of the firm, not necessarily ESG performance related information that doesn't, right? Not these non-pecuniary implications. So there also was a lot of debate, when the SEC rule was still just a proposal about whether this was under the SEC's rulemaking authority. Because the SEC's rulemaking authority is to enhance the functioning of capital markets, right? There's no such thing as the SEC. So the SEC is not mandated to combat climate change. Now, our results come in and say, yeah, this could enhance the functioning of capital markets because it seems like the very people that the SEC is trying to protect would benefit from more information about these very real risks that are facing firms. So then I think that does motivate and does support that this type of mandated disclosure, if it's about climate related risk, right, could be helpful and then therefore is under the SEC's purview.
Interesting. Well, speaking about mandates or regulation, Ben, a question for you is when we think about these quickly rising premiums, what are some policy implications for state regulators who oversee these insurance markets? I guess maybe some people are asking, can the regulators sort of help us keep this under control, or what are regulators thinking at the moment?
It's a really hard problem. The state regulators are in an awful bind, and in many states, this is an elected position. And so imagine running for office and saying that you were the person at the helm when insurance rates shot up by 35%. Right? It's a very challenging kind of position to be in. I think when I'm thinking about the kind of work that these state regulators are doing, I think part of it is trying to balance giving the insurance industry some additional flexibility in terms of what they're allowed to price on and what kind of sophisticated models they're allowed to use. So famously in California, there's a very tightly regulated state, despite the climate risks of wildfires and other risks. California is one of the cheaper states in the country for property insurance, and that's because of a very tightly regulated market that has, due to a proposition, a statewide proposition, has made it difficult for insurers to raise rates, and it also limits sort of the information that insurers are allowed to use when pricing these contracts. And so, that's a case where you then have some of the biggest firms in the country, like State Farm, publicly leaving the state. Well, State Farm doesn't have to issue a press release when they leave a state. They did this very intentionally. It's because it's part of an ongoing negotiation with the state regulator, saying, allow us to raise rates a bit more, allow us to use more forward-looking models of climate risk rather than just our historical disaster data, and give us a bit more flexibility, and so we can make more profitable, write more profitable contracts. So I think that just kind of highlights one of the tensions that these state regulators are also facing. On top of that, just briefly, many states are now increasingly dependent on a public provider of insurance. These are known as the state fair plans. In Florida, Citizens Property Insurance, the state residual program, has 1.2 million policyholders. It's the largest insurer in the state. And so the state regulator now is bearing an enormous amount of much more direct risk when they're issuing these policies. And there's a real, I think, difficulty there in setting the right price to actually make it reflect risk, because now you're sort of beholden to the voters of the state. Are you really going to be willing to set the price where it needs to be to sort of not only communicate risk to current homeowners, but also make better decisions going forward about where to build and where to invest. So it is a really tough spot for these state regulators. And it's a market that's very splintered because it is regulated at the state level. So you have sort of 50 different experiments going on across the country.
Yeah, that sounds like a pretty hard job indeed. So I guess, like you're saying, we can't really regulate ourselves out of this sort of increasing trend in premiums, which makes me wonder then, like, as a homeowner, what can people do about this? Like, do you have any tips for how to shop around or what to look for if you as a homeowner want to be a little bit careful and trying to keep it under control?
Yeah, we can't regulate our way out of it because insurance companies can pick up and leave, right? And that's what we've seen with State Farm. Sometimes there's this idea that insurers are the grown-ups who are going to tell it like it is when it comes to climate risk, and in a sense, they are. In terms of their data and their models, they are the mature ones in the room being realistic about this. To Christina's earlier point about who believes in climate change, right? The insurers, it doesn't matter. It's not a matter of beliefs for them. It's a matter of putting money where their mouth is. But they can pick up and leave, right? They have flexibility in ways that communities don't have, that state leaders don't have, and that homeowners don't have. So in that way, I think we can't rely on the regulation alone. I think homeowners need to get a lot smarter about this in a couple of ways. One is really understanding your risk. So going to a website like Risk Factor, which is run by the First Street Foundation, where you can get a diagnostic of your property. It's free, and you can put in your address and get information about flood risk, wildfire risk, heat risk, wind risk, and you can use the National Risk Index that FEMA puts out as well. So getting a real understanding of the risk. then shopping around for homeowners insurance. Most people set it and forget it, right? You take out an insurance policy maybe when you buy your house or maybe when you refinance. And then, it sort of automatically renews in the background. You're making those escrow payments. And so you're not really thinking about it. It's not top of mind despite all the advertising on TV. But there's big benefits to shopping around. The data that we've seen shows huge dispersion in quoted rates across different carriers because they're using different models. They have different data. And so you really should shop around. The one more piece to shopping around that people might not know is that if you've had a change in your credit score, you can sharply lower your homeowner's insurance if your credit score has improved. In most states, homeowners insurers are allowed to price on your credit score, and they do so aggressively. So if your credit score has gone up 10, 20, 50 points, then it's a good time to shop around again. I think it's just a matter of right sizing the policy, understanding your risks, and then shopping aggressively so that you can find the best deal.
Very good. And Ben, before I turn it back to Christina, like one sort of question in the spirit of data gathering, you mentioned a tool website earlier in your presentation. Could you mention again like what that tool is and where people can find it? I think to look at the premiums at a very granular level.
Oh yeah, so the premiums were posted on the New York Times website. With an article that was built off of the data that I was talking about before. So those 47 million records that we used, we aggregated them up to the county level and shared that data with the New York Times to get a sense of premiums. So they have an interactive map that you can go to, and you can go click on any county in the country, and you can see sort of here's what the average premium is, here's what the sort of the risk level is. And get a sense for it. So that was the map that I was referring to in terms of the tool when it comes to premiums. And then when it comes to assessing risks, I like the risk factor free version that the First Street, which is a nonprofit, makes publicly available, and FEMA's National Risk Index.
Great, thank you. Christina, I was curious if there's any evidence that different types of retail investors might have different preferences when it comes to companies' ESG performance, or maybe that different types of investors have sort of more or less of these non-pecuniary preferences. Like if you think about millennial or Gen Z investors, for example. Do we know anything about this?
Yeah, so there has been some survey evidence on this, right? So when there have been multiple surveys actually that have looked at, asked different age groups, right, different generations, and they do tend to find similar things, which is that the younger the investor is, the more likely they are to say that they are a values investor, meaning they're willing to sacrifice some part of the value of their investment if they can influence companies' ESG policies or practices, or if the company can impact, the world in that way. So millennial, Gen Z, they're more likely to be these values types investors with non-pecuniary preferences, at least when you survey them and you ask them. So this is a question that we were really interested in as well when we were looking at the data, seeing if we could see whether what they say was consistent with what they did when they traded on these ESG events. So what we were able to do was we were able to get data from Robinhood to see whether Robinhood investors traded in a different way from the rest of the retail investors. And one reason that we might think that they could trade differently is because Robinhood investors are more likely to be these younger investors, right? So we would expect to find these non-pecuniary preferences there if they existed in that Robinhood sample. But we still didn't find it, right? What we found in the Robinhood sample was very similar to what we found in our main sample, which is that these retail investors, even these younger retail investors, seem to care about ESG related information because they care about how it impacts risk and returns, but not in the sense that they want to do good for the world. Maybe they're going to do it in some other way, but not when it comes to their portfolios or stock portfolios and their trading.
Interesting. And I guess that sort of leads me to sort of a final question before I turn it over, or I will, get to the audience Q&A, which is sort of how do you reconcile your results on, people seem to just mostly care about risk versus return with this growing investor demand for ESG funds and the growth in the amount of money that's invested in these funds over time?
Yeah, so definitely very much related to your earlier clarification point about what ESG trading is, like what's an ESG fund even, right? So we have seen a lot of growth in ESG funds, but I do want to note that the amount of assets that are strictly tracking ESG outside of the effect on performance is super small. So there's some survey evidence showing that about 18% of North American funds consider ESG to be their primary motivation in their investment approach. But even among those 18%, most of them are trying to maximize portfolio performance. It's just that they're using ESG integration approaches, meaning they're using ESG information to help them maximize portfolio performance. And this is consistent with, fiduciary duty in the US as well. So our results would be consistent with the growth in funds that are integrating ESG information to maximize portfolio performance.
Great. So I think I'll get to some of the questions that our audience is asking. So Christina, question for you first. So when it comes to these ESG news stories, are there certain types of stories, maybe climate stories versus a story around sort of social performance that are more salient for retail investors? And are there differences in the way they navigate risk, return and event disagreements for different types of issues?
Oh, okay. That's a really interesting question. I think I can answer the first part, but maybe not the second part because we didn't necessarily look into that yet. The first part was about whether certain types of events are more salient for retail investors, and that's definitely true. And that's something that we thought about and we care about because the more salient the event, right, the more the retail investor is likely to trade on this type of information. So it does seem like it's pretty consistent with what we found in terms of what the survey evidence was saying, was that retail investors seem to care a lot about the governance type events, social capital events, environment not as much. And this could be consistent with the news media's coverage, right? So a lot of these events, let's think about the Boeing 737 MAX event. That's a governance related event that was covered widely in the media. And so it's salient in the media, retail investors care about it more. It's not necessarily because it's a governance related event, but it could be related to that because there's a reason the media cares about it more. Maybe they think retail investors care about it more. So we do see some of that. Now, in terms of the non-pecuniary preferences, and how that lines up with the different types of events, that we have not looked into yet, and that would be interesting to look into. I would be surprised if we found any non-pecuniary preferences, given that we used many different subsamples in terms of, like I mentioned, the Robinhood investors, blue and red states, and we still didn't find anything. But that's an interesting thought that we could look into.
Great. Ben, a question for you. So we see insurance premiums going up, and the question is, are they going up sort of to levels that are high enough to disincentivize people to move into these very risky areas? Maybe sort of around the Florida coast or the Louisiana coast that you mentioned earlier.
Yeah, I mean, I think it's related to like whether we would start to see this reflected in house prices. And I do think we are seeing this disincentive effect leading to a rise in unsold properties, which to me suggests that there is a disincentive for some current buyers at today's prices to move to these areas. One of the other takeaways from our paper, which I didn't have time to go into, there's way more stuff in the paper than I could cover in 4 or 5 minutes, is we looked at this relationship between how the insurance industry prices disaster risk. And what we found is like a 1 standard deviation increase in your disaster risk index was previously associated with about a $300 increase in your insurance premium. Now it's associated with a $500 increase in your insurance premium. So just to fix the idea, it's like, what does a standard deviation change? Like, what do these numbers mean? Orleans Parish, Louisiana, where New Orleans is 4 standard deviations above the average. And so based on our metric, that would mean that on average, they pay about $2,000 more per year for homeowners insurance. And that's the right ballpark. The national average is around $2,500. And in New Orleans, it's close to $5,000 a year. And so if we think that's a pretty recent change, just in the last 3 years, going from $300 to $500 for each standard deviation of disaster risk, that is what we think is going to be that price signal that over time people are going to have to grapple with. That's going to be capitalized into these housing markets over time, and that's going to be the disincentive. That said, to this sort of broader idea of like, are markets pricing climate risk? At the moment, they're not, right? We don't think that that housing markets are fully pricing climate risk. And some of this relates to Christina's point earlier about differences in beliefs and disagreement about the severity of climate risk and the paths of future climate risk. It's also related to all the other ways in which we subsidize living in risky areas. So the mortgage market chooses not to price geographic risk. Fannie, Freddie, and the FHA don't price regional risk. I have earlier research on that. We know that there are a lot of other programs that help out after disasters. There's a lot of other infrastructure spending that is provided nationally and to rebuild in the same places over and over. And so we have these repetitive lost properties. And then we have the National Flood Insurance Program, which has underpriced flood risk for decades, very much intentionally and well aware of that underpricing. So I think there's a bunch of other ways in which we subsidize risky living. And just because we see an increase in insurance costs, that doesn't mean that the market is going to be kind of pricing this in an accurate way going forward. So I think this is going to be a small disincentive, but at the moment, it's relatively small compared to the overall basket of incentives that we provide to live in risky areas.
Great. Christina, we have seen, a number of previous research papers, including, by the way, by Luke Taylor, who's in Wharton's finance department, that asked the question: do ESG stocks or green stocks outperform, say, brown stocks? And so the question is, like, have you looked into that question for the retail investors? Is it actually, was it a good deal to invest in ESG stocks, even though the official motivation that people give might be more ethical?
Yeah, so if I try to reconcile our results with Luke Taylor's results and some of the other previous research on like the green stocks premium, it would be consistent if, right, because we're trying to disentangle, like, is it because of some underlying cash flow reason, or is it just because these retail investors prefer to own green stocks, even if you look at two identical firms, right? And so our evidence would say they do prefer the green stocks if being green means that the returns are going to be better, similar to what I think they find in that paper, which is that sometimes green stocks can outperform the market. And in that case, a retail investor would do well by investing in green stocks. Some of this could be because of like an underlying cash flow reason, like green stocks, for example, if people are driving electric cars, right? People prefer not to pollute, right? Then naturally that company's cash flows are going to be higher if it's a green stock, right? As opposed to a brown firm. So that would be consistent, right? That's where this ESG information about whether it's green or brown and to what extent would be useful for a retail investor to know, because that is going to affect the risk and return of their portfolio.
And I think a follow-up question here that just came in, it's like, is there a market cap delta percentage associated with specific ESG trading areas? So I think LGBTQ is mentioned as an example.
A market cap delta percent, meaning like, so I'm going to interpret the question as, are people preferring certain types of stocks to others?
Yeah.
Again, not so. So I think if I were to generalize our research to that research question, I would say that there would be, once again, if there is some cash flow implication. So what I'm thinking about right now is that Hasbro example in our sample, which is when Hasbro dropped the Mr. from Mr. Potato Head, right? So now you can have a gender inclusive family, any type of family unit. And that was a positive ESG event because that was positive social capital, positive customer welfare. But it was also a positive stock price reaction. And that's because what I'm thinking is the market saw this and said, wow, now our total addressable market for our customers is much bigger. We can reach a broader customer base. Maybe customers like the flexibility of making whatever family unit they want with the potato heads, right? And so that was why the market really liked that. And so you could imagine that in these types of scenarios, there could be this delta, right, between certain types of firms or certain types of products offered by firms versus other types of products.
Very good. Let's circle back to to the home insurance question for a moment. And so, Ben, you talked about state regulators explaining that it's sort of a complicated patchwork of every state doing different things, which begs the question: is there a role for federal regulation here? Would that make things better?
Yeah, this is a hot topic of discussion on Capitol Hill at the moment, and a number of other groups in DC are really interested about this, whether there's a larger role for the federal government to play. Now, historically, the federal government has played almost no role in regulating insurance markets, and that's due to interstate commerce laws, and a number of congressional bills that have made it challenging to take a role. The U.S. Treasury got involved coming out of Dodd-Frank with the creation of a new federal office of insurance, Federal Insurance Office, I think. And so, I think there are a number of conversations about what role an office like that could play. One of the examples that we have, though, already in place is the National Flood Insurance Program. So the National Flood Insurance Program grew out of basically an unwillingness or a lack of interest among insurers to offer flood insurance. And so they would write these insurance contracts for homeowners and say, well, we'll cover everything except floods. Of course, what's the thing that homeowners are most concerned about? What's the thing that would really wipe them out is a flood, right? So it became kind of imperative to create something that would fill this gap. And the National Flood Insurance Program was created. It's lost at least $30 billion over its existence because it's underpriced this insurance. There's been a real unwillingness to set the price appropriately. And recently, with a couple of reform efforts, there's been an increase. It's called Risk Rating 2.0 that's driving up the premiums in this program. And now there are a number of states that are rebelling against this, that are filing lawsuits and saying that it's not acceptable to raise these rates. So it puts the federal government in a tricky spot. And I think there are a lot of discussions that are saying, well, why don't we broaden the National Flood Insurance Program to cover wildfires or to cover hurricane force winds or other kinds of disasters? That would be entering the market at kind of the primary level, like writing policies to homeowners. I think there are others who say, no, we should create a reinsurer that's a federal reinsurer that kind of wraps the risk of these insurance companies. And maybe that's a more sensible way to come in. So these are all on the table. There's some really fascinating conversations happening in DC, some of which I've been lucky to be a part of and others which I'm not. But really enjoying sort of the discussions on trying to diagnose the problem and then think about what an appropriate solution might look like. And whatever it would be would likely be somewhat unprecedented in this space, given the preeminent role of the states in regulating insurance.
Christina, funds have sustainability ratings. We read about this from time to time. I guess a question that comes up is, do you think retail investors really care about those ratings?
Yeah, so this is a really interesting question that has attracted quite a bit of research and some conflicting research, I would say. But I think a lot of it's because we do have evidence that retail investors respond to the sustainability ratings, but then it's a lot more difficult to understand why are they responding, right? So there was a shock to Morningstar sustainability ratings, and then the funds that had higher sustainability ratings gained more flows, right? So one interpretation of that is that retail investors really care about higher rated funds, right? They want to invest in sustainable funds. But then there was some other research that came out that showed that after a year, that relationship goes away, right? So then, you don't see that anymore. So then the interpretation there is that it was really a salience shock, right? It's that these ratings just became salient. Retail investors saw these numbers and they said, oh, well, these numbers must mean something. I'm going to go buy the best funds, right? Without really understanding what the sustainability rating was indicating to them. And then another really interesting paper that I saw recently was looking at one of the rating providers, and I forget which one, they changed the scale, right? From 0 to 100, 0 meaning good, 100 meaning bad, and they flipped it. 100 means good, 0 means bad. And then you see that even though nothing underlying changed, just the indication of what 0 versus 100 meant, retail investors did seem to be changing their flows in that direction. So this would indicate that retail investors and most of us, right, we have some information processing constraints, right? It's really difficult to understand what these numbers mean, especially when you're getting them from so many different sources. So I think the jury's still out on whether retail investors care about these sustainability ratings, because it seems like they do trade in response to them, but then it's unclear why and how much of it is due to them not understanding what these numbers actually mean.
Well, thank you. I think we're getting to the last question. I think I have a last question for both of you to answer. We'll do a lightning round in 30 seconds or so. I'm kind of curious, like, what is your what's the next project that you're excited about for your next ESG research endeavor? Maybe Christina, we can start with you.
So I'm still thinking about the next project, but a lot of it has to do with like how much of this climate risk is being priced, right? I think, we talked about it a little bit. You mentioned that a little bit earlier too, right? Sometimes it's priced, sometimes it's not. My next project probably has to do with to what extent is it priced and what are the implications when it's not priced? So I know it's very broad, but I'm still trying to figure it out.
Yeah, like Christina, we're very interested in this pricing question, whether it's being capitalized into house prices, and then I think there's a number of additional nuances in the insurance market that have not been studied, and so having this really rich data is going to open some doors there. One is related to these non-renewal decisions, insurers leaving certain markets, and what are the consequences for competition and ultimately for the cost of premiums when competition falls in some of these markets, even in places that you wouldn't expect, like parts of Oklahoma, for instance. We've heard stories about insurers saying, look, I just can't model these convective storms, the tornadoes and hailstorms, so we're just going to leave. And so even places where you'd think there should be a competitive market, there are fewer players in those markets than you might expect, and we want to understand what the implications are for households.
Great, thank you very much. And I think with that, I will turn it back to Robin.
Wonderful. Thank you, Arthur, Ben, and Christina for today's session, and to all of our alumni for joining us today. The session has been recorded and will be available on our webinar library page in the coming days. We hope you enjoyed today's webinar, and there will be an email with our webinar feedback survey sent to you later today. And now I'd like to turn it back to Arthur for his final thoughts.
Great, thank you. Well, I hope everyone enjoyed today's webinar. What I would like to do in the remaining minute is to draw your attention to another upcoming webinar organized by the Wharton Climate Center that may be of interest to many of you. This is going to be on Monday, November 18th from noon to 1 Eastern Time, and it's titled, So You Want to Be on the Board of a Climate Company? And this is an event that will feature 3 Wharton alums, Lamar Brown from the Negocium Group, Jeffrey Harris from Quantum Innovation Fund, and Jake Sussman, the CEO of Ambient Fuels, who will discuss being on the board of a climate solutions company, followed by Q&A from the audience. And the speakers are going to discuss the various types of boards that climate-related companies have, what it takes to be on a board, what kinds of issues arise, and how to join a climate company board. So we will send you a separate message after this webinar with a registration link. And with that, I would like to thank you all for your interest and attention, and have a great rest of your day.